Welcome back to the deep dive. Today, we're focusing our analytical lens squarely on SoFi Technologies, Inc., ticker SOFI. We're digging into their Q3 2025 earnings report. And, we're not just here to react to the stock price. We really want to understand the financial mechanics behind this performance.
Absolutely. The market reaction, it was positive, but our mission, like you said, goes deeper. We're using a structured approach, basically five key analytical points to see if this quarter is, just a blip or if it really validates SoFi's long-term plan, their whole transformation strategy towards being a more diversified, profitable financial player.
Right. That's the core question. Is this success sustainable? We've got quite a bit to unpack, so let's jump right in and set the baseline. What did the numbers look like at first glance?
Okay, let's start with the immediate scoreboard.
Now for slide one, the at-a-glance scorecard. Okay, so starting with those headline numbers versus expectations. This was, a clear beat, right?
Oh, definitely. Total net revenue hit $961.6 million. That was significantly ahead of the $890 billion Wall Street was looking for.
And the bottom line followed suit.
It did. Diluted earnings per share came in at $1.11. It was 3 cents higher than the $1.08 estimate. So solid beat on both fronts.
And the market noticed, I assume.
Yep. We saw that immediate reaction. The stock popped roughly 3% in pre-market trading right after the release. But, beating estimates is one thing. What really tells the story is the year-over-year momentum.
Okay, so how did they stack up against last year?
Pretty strong. Total revenue grew a robust 38.0% compared to Q3 2024.
38% is great growth, but I think you pointed this out earlier, the really eye-popping number was on the net income line.
Exactly. That's where it gets really interesting. Net income available to common shareholders grew, get this, 140.5%.
Wow, 140%.
Yeah, it climbed from about $58 million last year to almost $140 million this quarter. And this is, it's textbook operating leverage in action.
Meaning their costs didn't scale up as fast as their revenue.
Precisely. Key expenses like sales and marketing and G&A, they grew slower. S&M was up about 33.5%, G&A up 26.5%, both well below that 38% revenue growth. So as the business scales, the profit is just accelerating much, much faster.
That's the dream scenario for a growth company, that acceleration. But I did notice something, a little detail that sometimes trips people up. Net income grew 140.5%, fantastic. But the diluted EPS only grew 120.0%. There's like a 20 percentage point gap there. Why didn't the per-share growth keep pace?
Oh, good catch. That gap really highlights the impact of share dilution. It's something every investor needs to watch. Even though the company earned, 140% more profit overall, that bigger profit pie had to be split among significantly more shares.
Right, so the pie got much bigger, but the number of slices also increased, watering down the per-slice gain a bit?
Exactly. The weighted average diluted shares outstanding, that number increased by almost 17%. 16.9% year over year. That expansion, mostly from things like stock-based compensation, it just tempers the growth rate when you calculate it per share.
Okay, so 120% EPS growth is still fantastic, obviously, but understanding that dilution piece is crucial for valuation.
Absolutely. It gives you the full picture.
Okay, so we've established the volume of profit is strong and accelerating. Now we need to check the quality of that profit. Where did it come from?
Right. Moving to slide 2, the engine of profitability.
Okay, for any bank or lender, net interest margin, NIM, is like the vital sign, right? It shows how efficiently they're making money on their loans. Did we see that margin get better or worse?
Definitely better. We saw expansion. Importantly, it looks structurally driven. NIM improved to 5.84% this quarter.
Okay, 5.84. How does that compare?
It's up a solid 27 basis points from 5.57% last year. And what's really interesting here is the why. It's not just about higher interest rates generally. It's really about the strategic advantage they get from having their bank charter.
Okay, explain that link. How does the bank charter directly boost their margins?
Well, it dramatically lowers their cost of funds.
Yeah.
They can attract consumer deposits now, right? And management actually put a number on it. They said this deposit funding is 190 basis points cheaper for them compared to their old way of funding through warehouse lines.
Wow, 190 basis points. That's huge in banking.
It really is. It's a durable, widening competitive advantage, a moat.
And the sources actually quantified that. They translated that advantage into roughly $627 million in annualized interest expense savings.
Exactly. That's money they just don't have to pay out each year because of that cheaper funding. That's serious margin safety. It's real cash generating power.
Speaking of cash generation, that brings us to the GAAP versus non-GAAP discussion. Adjusted EBITDA looks strong, up 49% year over year to about $277 million. Why should you, the listener, pay attention to adjusted figures like EBITDA? Don't they just strip out costs?
Well, yes, but they strip out specific types of costs, often non-cash items or things that aren't related to the core day-to-day operations.
Mhm.
It helps clarify the underlying operational trend.
So what were the big adjustments here?
The two main ones were share-based expense, about $66.5 million. That's non-cash compensation, remember. And then a negative adjustment, about $12 million, related to how they value their servicing rights. Again, a non-cash accounting thing. So by pulling those out, adjusted EBITDA gives you, I think, a cleaner signal of the core business's health and its ability to generate actual cash from operations. It confirms that things are indeed growing strongly underneath.
Got it. So, strong headline growth, improving margins thanks to the bank charter, and solid underlying operational cash flow. Now, let's break down where in the business this is all happening.
Okay, now for slide 3, performance by business segment.
Right. Looking at the contribution profit and margin for each segment, this is really where we test that one-stop shop strategy, isn't it? Let's start with lending, the traditional core.
Okay, lending. Still the biggest piece by revenue, $493.4 million, and that was up 25%. So good growth. However, that growth seems to be getting more expensive. Contribution profit only grew 9%.
Only 9% profit growth on 25% revenue growth, that implies.
Margin compression, yeah.
Yeah.
The contribution margin actually fell pretty significantly, from 60% last year down to 53% this quarter.
So, if they're making more loans but definitely earning less profit on each loan on average, makes sense perhaps in a tougher competitive space or maybe focusing on different loan types?
Could be a mix of factors. Now, compare that to the technology platform. This includes Galileo, right? The supposed tech backbone.
Yeah, how did that segment do?
This is where we saw some, well, weakness. It was the slowest segment overall. Revenue only grew 12% to about $115 million. And maybe more concerning, its contribution profit actually declined by 2%. And the number of enabled client accounts was down 1% year over year.
Wait a second, down 1% on client accounts for the tech platform. If the whole strategy relies on tech for scale and efficiency, isn't that a bit of a red flag? Why would Galileo be shrinking its client base?
It absolutely raises a question. Is it market saturation? Is it competition heating up in that B2B space? It definitely warrants watching. However, the story this quarter is that this weakness was completely, utterly overshadowed by the third segment, financial services.
The newer one-stop shop products, what happened there?
This was the blockbuster. Really drove the results. Revenue surged 76% to nearly $420 million. And because that infrastructure is largely built out, the contribution profit grew even faster. It was up 126% to $225.6 million.
Wow, profit growing almost twice as fast as revenue in that segment.
Exactly. That's the operating leverage you want to see. The contribution margin expanded dramatically, widening from 42% last year all the way up to 54% this year.
So as people use more SoFi products, checking, savings, invest, credit cards, the cost to serve them just drops.
That's the idea. And here's the really crucial milestone that the sources flagged.
Okay.
If you combine the revenue from those two capital-light segments, financial services and the technology platform, their combined revenue was $534.2 million.
Okay. And lending was?
Lending was $493.4 million.
So the capital-light businesses combined are now bigger than the traditional lending business.
The milestone is officially crossed. This isn't just a lending company trying other things anymore. This quarter really validates that strategic pivot. The diversified, higher-margin, capital-light model is now, arguably, the main event.
That's a fundamental shift in the company's profile, and that kind of shift, especially towards banking services, really puts the focus on the balance sheet strength.
It does. Moving to slide 4, financial strength and capital flexibility.
All right, for listeners maybe not steeped in bank metrics, we need to talk CET1 ratio, Common Equity Tier 1. Can you break down what that is and why SoFi's number matters so much?
Sure. CET1 is basically the gold standard for measuring a bank's financial resilience. It compares the bank's highest quality capital thing, common stock, retained earnings, the real core stuff, against its risk-weighted assets. Essentially, it's asking, how much of a buffer does the bank have using its best capital to absorb unexpected losses on its loans and investments?
Okay, so higher is definitely better. More cushion. What's SoFi's cushion look like?
It looks extremely comfortable. Their estimated CET1 ratio as of the end of Q3 was 20.0%. 20%.
And how does that compare to what's required?
Well, regulatory minimum is only 7.0%.
Wow. Okay, so they have nearly 3 times the required capital buffer. That's not just strong. You called it a fortress balance sheet earlier, and that seems about right.
It really is a strategic asset. That huge capital surplus gives them two massive advantages. First, obviously, incredible protection if the economy turns sour. But second, and maybe more importantly right now, it gives them immense flexibility to grow aggressively. They can fund record loan originations like they did this quarter and pour money into innovation without constantly needing to go cap in hand to the market to raise external funds.
Which is a huge plus in a higher interest rate world, right? Having that internal funding capability.
Massive competitive advantage over fintechs that don't have a bank charter or this kind of capital base.
Okay, that strong foundation naturally leads us to think about the future. How is management signaling their confidence going forward?
Right. Finally, slide 5. The road ahead management's outlook and key takeaways.
So, with all this underlying strength, the beats, the margin expansion, the segment shift, the fortress balance sheet, it's no surprise. Management raised their guidance for the full year 2025, right? Shows they think this is sustainable.
Yeah, absolutely. They didn't just nudge it up, they raised the goalpost pretty significantly across the board. Adjusted net revenue guidance went up to $3.54 billion. That's up from their previous forecast of around $3.375 billion.
Okay, what about profitability?
Adjusted EBITDA guidance got a nice bump too, up to $1.035 billion from $960 million previously. And importantly, adjusted EPS guidance was raised quite a bit, up to $37 per share from 31 cents.
And they're still expecting strong user growth.
Yep, they reiterated they expect to add at least 3.5 million new members this year. It's a comprehensive show of confidence in the trajectory.
Okay, so let's try and tie all 5 of these threads together. If you had to distill this whole quarter down, what are the, say, 3 main takeaways for you, the listener?
Okay, 3 things. First, I'd say the one-stop shop strategy is now clearly validated by the financial results. It's not just a concept anymore. That explosive high-margin growth in financial services, pushing the capital-light segments past lending and revenue, that's proof. Second takeaway, profitability isn't just growing. It seems to be structurally improving because of that widening competitive moat, the low-cost deposit funding for the bank charter. That NIM expansion is key and looks durable compared to non-bank competitors. And third, that immense financial strength, highlighted by the 20.0% CET1 ratio. It's not just a safety net. It's fuel for aggressive, internally funded growth and innovation. It's a real strategic weapon.
So putting it all together, this quarter feels less like just a good quarter and more like a confirmation. Confirmation that SoFi's big transformation, their pivot towards being this diversified, structurally profitable financial institution, well, it's actually happened. It's real, and it's driving the numbers now.
Exactly. And that brings up, I think, an important question for you, the listener, to really mull over after hearing all this. Given that these capital-light segments, financial services, and tech are now officially bigger than lending in revenue terms, and financial services is driving that high-margin growth, how should that shift change how you think about SoFi's risk profile? And maybe, just maybe, how the market values the stock going forward. Does becoming less reliant on capital-intensive lending warrant a different valuation multiple? Something to think about.
That's a great point to leave things on. Just a quick note before we wrap up. Remember, this report is purely for informational purposes. It doesn't constitute financial or investment advice. Please always do your own research and consult with a qualified professional.
And also, please keep in mind that this analysis was generated with the assistance of an artificial intelligence model, integrating data from SoFi's official press release and public market sources. Independent verification of any data points is always a good idea.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.